Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Bain Capital Specialty Finance, Inc. quarterly report. Bain Capital Specialty Finance, Inc. is a business development company that provides various financial services to middle-market companies. The company specializes in direct loans to these businesses, offering a range of investment options. The fund's portfolio includes senior investments such as first or second lien on collateral, senior first lien, and stretch senior loans. It also invests in senior second lien, unitranche, mezzanine debt, and junior securities. Additionally, the company provides other junior investments and secondary purchases of assets or portfolios that primarily consist of middle-market corporate debt. In terms of investment criteria, Bain Capital Specialty Finance typically targets companies with an EBITDA between $10 million and $150 million. This indicates a focus on established businesses with stable cash flows, providing a solid foundation for the company's lending activities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth and decline can be identified through a review of key financial metrics. On the growth side, proceeds from principal payments and sales of investments contributed $245.9 million to revenue. Additionally, net increases in assets resulting from operations added $3.4 million, while new debt issuances and borrowings under existing credit facilities provided significant influxes of capital. Investment income, including interest, loan origination fees, dividends, and capital gains, also played a crucial role in driving growth. On the other hand, revenue decline was driven by purchases of investments totaling $299.4 million. Furthermore, net realized losses from investments resulted in a decline of $9,628, while increases in investments due to payment in kind, PIK, arrangements added to the decline, amounting to -$7,385. These factors highlight the importance of investment management and financial planning in driving revenue growth or mitigating decline. The analysis of net income and profit margins reveals a mixed trend. Initially, there was a decrease of 7.2% in net income from $33,186 to $28,270. However, this decline is contradicted by another instance, where net income actually decreased by 18.4% from $1,022 to $834. Furthermore, the net income plummeted from $28.547 million to $3.39 million. The decrease in profit margins can be attributed to several factors. Firstly, a reduction in net realized and unrealized gains/losses, coupled with an increase in expenses, led to a decline in profit margins. Additionally, despite an increase in net revenue, the significant rise in net operating expenses resulted in decreased profit margins. The net investment income before taxes also witnessed a 14.7% drop from $33.186 million to $28.27 million. These changes indicate a complex and multifaceted impact on the company's financial performance. The company's financial performance indicates a significant improvement in its ability to generate cash from operations. For the 3 months ended March 31, 2026, the company reported a positive operating cash flow of $26.6 million, compared to a negative operating cash flow of -$7.3 million for the same period in 2025. This represents an increase of $33.9 million in operating cash flow over the past year. This improvement is a positive sign for the company's financial health and suggests that it is better equipped to meet its short-term obligations. The ability to generate positive operating cash flow also indicates that the company has a stable revenue stream and is able to manage its expenses effectively. Overall, the data suggests that the company is generating sufficient cash from operations to support its business activities. The company's debt level and interest expenses have undergone significant changes over the past period. While there are inconsistencies in the data, it is clear that the debt level has fluctuated. In some instances, it has decreased, such as from $381.4 million to $372.5 million on March 31, 2026, while in others it has increased, like from $2,077,000 to $2,127,000 during the same period. However, a closer look at the interest expenses reveals a more stable trend, with a few exceptions where they have increased, such as by $1.4 million from $18.9 million to $20.3 million. The interest expenses have generally decreased or remained steady. For example, they decreased by $2,592 for the 3 months ended March 31, 2026, and by $2,082 for borrowing interest expense. Overall, while the debt level has experienced fluctuations, the interest expenses have shown a more consistent trend of decrease or stability. The performance of various segments and regions in the financial market has been mixed. In terms of loan types, first lien senior secured loans have shown significant improvement with 64.9% amortization and a fair value of 63.8%. On the other hand, second lien senior secured loans and subordinated debt have underperformed, with only 1.2% amortization and 4% respectively. In contrast to these loan types, preferred equity and equity interests have performed well, with returns of 4.9% and 8% respectively. Geographically, the USA has been a standout performer, with 87.8% amortization and 86% fair value. The Cayman Islands also showed strong performance, with 4% and 4.1% respectively. However, several regions have underperformed, including Ireland, Italy, Jersey, France, and Guernsey, which all recorded negative returns ranging from -0.6% to -0.2%. Overall, the data suggests that certain segments and regions are outperforming others, highlighting opportunities for investors to diversify their portfolios. Management is optimistic about the company's outlook, citing opportunities within Bain Capital Credit's senior direct lending strategy. They plan to capitalize on these opportunities by investing in senior debt with strong structures and documentation, while utilizing leverage to increase total capital available for investment. The company's strategy focuses on middle-market companies with EBITDA between $10 million and $150 million, and they are willing to invest up to 30% of their portfolio opportunistically in non-qualifying assets. Management emphasizes the importance of portfolio construction and risk management, as well as ongoing monitoring of financial performance. In terms of funding, management expects to generate cash primarily from cash flows from operations, future borrowings, and future offerings of securities. They also intend to raise additional equity or debt capital through registered offerings, enter into additional debt facilities, or increase the size of existing facilities or issue debt securities. Overall, management's strategy is centered around investing in senior debt with strong structures and documentation, while utilizing leverage to increase total capital available for investment. They are confident in their ability to generate cash and maintain a nimble approach to responding to market environments while maintaining high credit standards. That concludes the financial summary for Bain Capital Specialty Finance Inc. Feel free to comment below, and I will be happy to answer them when possible.